A Ford is a financial product that is modelled off commodities, things like oil, gas, iron, corn, and even pigs. Usually, a financial institution like a bank will come up with a price that they think the commodity will be worth in, say, 6 months' time. They'll then sell that to another company or individual, and they'll then be legally obligated to buy the commodity off the bank in the future at a set date. So, why is this useful? Well, let's look at oil as an example. Let's say an airline uses 10 barrels of oil each day to fuel their planes, and at the current market price, each barrel is worth $20, which means their total fuel cost is $200. Great, they know that their fuel costs today are $200, but now they want to start budgeting in the future. They want to know how much their fuel costs are going to be every day for the next 6 months. This is where Fords become useful. So the company goes to the bank and says, in 6 months' time, we want to buy 10 barrels of oil. The bank then comes back and says, okay, in 6 months' time, each barrel of oil will cost $23 because they've done some fancy calculations. Then they enter into a contract where the underlying is the pre-agreed quantity, in this case 10 barrels of oil. The delivery date is 6 months from today, and the Ford price is $23 per barrel. The airline can then budget for fuel costs to be $230 in 6 months' time. Now, the bank makes a profit if the actual market price of a barrel of oil is less than $23 on delivery date, since they can buy the barrel of oil at market price and sell it to the airline at $23, which was the pre-arranged price. They would make a loss if it was higher than $23. But individuals can also buy oil Fords, so what good would that be for you and I? Well, I don't want an oil Ford because I have no use for the oil. This is solved by the bank not actually giving you the oil on delivery date. Instead, they give you the cash to go out and buy it yourself at the market price, or in our case, put it in our back pocket. So say as an individual, I think the price of oil is going to go up dramatically in the next 6 months. The bank, on the other hand, only thinks it's going to go up $3 to the price of $23 per barrel. So I buy a Ford contract with them at $23 per barrel for 6 months from now. And it turns out I was right. The price of oil has now jumped up to $30 from $20. So I pay the $23 to honour the contract, and they give me back $30 because that's the current market price of oil. And I make a $7 profit. What happens if it was the other way around though? What happens if the price of oil had gone down to $19? I'd still have to pay $23 to honour the contract, but they'd only give me $19 in return, since that's the current market price of oil. And that would leave me with a $4 loss. And that is a Ford contract, an incredibly useful tool for companies to plan and risk minimise, and an opportunity for individuals and investors to make some money.